Welcome everyone to the daily. Oh,
All right, let's test that out. 1, 2, 1, 2. All right, testing 1, 2, testing 1, 2. All right, much better. Perfect. Excellent. All right. Welcome everyone to Daily Bread for November 7th, 2025. I'm your host, Tom Hartman, going over the market news, macro news online today. Now, I wasn't here yesterday because, frankly, nothing happened. It was a pretty boring day. And even though the market went down, there was no like news within the macro sphere, within FinTwit or anything like that that really pointed to what was going on more than what we talked about during the last week. But today, all kinds of new information came out, all kinds of new commentary is there for us to review. So let's take a quick look. We're going to start off first with Tom Lee. Now, I don't have a particular strong opinion on whether Tom Lee is right or wrong. What I like is to pay attention to people who are regularly in the markets, regularly out there talking about what they're investing in, what they're seeing, because then I can use them as a barometer. There's going to be some subjects they're better on or worse on in general, and oftentimes they have more access to news, to information than I do, or they've synthesize more of the public information than I have. So I find it useful. Tom Lee is one of these guys, and he has quite a bit to say about the state of the markets. They talk to him about crypto all the time, since that's the bread and butter. That's his spiel that he's been peddling around for a while now. I mean, I say that peddling like it's a bad thing. We all peddle our spiel. All right, let's see what he has to say.
All right, well, check out Bitcoin because that's rallying more than 3% after dipping below $100,000 yesterday for the first time since June. So what does today's bounce back mean for crypto and for the broader market? Joining us now is Tom Lee, Fundstrat Head of Research and CIO and a CNBC contributor. And Tom, it's great to have you back on.
Great to see you.
So let's start right there because we did have a bit of a bounce back here in Bitcoin and really across the crypto landscape today. But yesterday, as Katie Stockton over at Fairlead pointed out, Bitcoin broke below its 200-day moving average. I know she's watching some technicals there pretty closely. How about you?
Yeah, I mean, I think it makes sense to watch the technicals for Bitcoin. As you know, Bitcoin is very sensitive to market liquidity and also perceptions about risk appetite and risk premia. And, over the past couple of weeks, I think there have been headwinds building, right? From the government shutdown to a hawkish Fed cut that was done last month and uncertainty about December. And as you know, with the shutdown, Treasury liquidity, the Treasury general account's actually been building cash. So I think all of these created a cascade of problems that put pressure on crypto. But hopefully, as you know, headwinds become tailwinds when you can resolve these things.
Yeah, I want to hone in for a second because I'm not sure we've been talking enough about it, but that funding stress we've seen in SOFR, I know there was data that was put out on Monday showing just a huge drop in that secured overnight financing rate on Halloween from the day before. Should we be paying closer attention to that and what that's meant in terms of the liquidity picture across asset classes?
Well, people definitely pay attention, Morgan, because one, as you know, that can often be an early sign of stress, but it also takes place when there's window dressing. So and banks are doing window dressing at the end of months. So I am kind of watching it, but I think those funding stresses have eased, and of course, it hasn't spilled over and reflected in what should be building stress in either credit markets or in bank equities. And so I would just say that it's an anomaly, and it may be due to the shutdown. But
All right, so a couple of points there. So yeah, he does talk about the idea that at the last Fed presser at the end of October, Powell did come out and say, "Hey, it's not a foregone conclusion that we're going to cut in December." So that's hey, we're not sure what's going to go on there. To touch on that, there was a if we take a look at the probability here, this is from a post from Bar Chart today, who says that the December rate cut, the odds of it has fallen to a 62% odds, whereas 10 days ago, the odds were 90%. This actually happened around the right after the Fed presser. So the odds dropped precipitously, which is interesting because chances are the Fed is going to cut. That's not something I'm particularly worried about. And if we take a look at the odds of the Fed cutting in December, we have here on Polymarket the odds of a 25 basis point cut is 73%. Now, I like odds like that because at 73%, you have a $100 gets you $136, and that feels like sort of like free money because the odds that they're not going to cut, I don't know how high that is, but I'd be pretty surprised. But who knows? You could always take that bet and see what that's like. But when the odds adjust drastically like that, that's an opportunity for a trade, which I also like. Okay. Daily Bread is not about taking trades, but I couldn't let that pass. The next thing he's talking about in the is the SOFR rates. So he was asked about the SOFR rates, but that interview was from a little while ago. If we take a look at what Nick Timrose was saying on X here about the overnight borrowing rates, the SOFR rates, we have here a post. He says overnight borrowing rates have settled out at a more normal level following the month-end pressures last week. That's the window dressing that that I was talking about. So give me 1 second here. One moment, folks. All right. So the standard repo facility usage was nil for the second straight day, and repo rates are now back in the same range the Fed has set for its benchmark Fed funds rate. So it's back to normal. Take a look at the chart. We see that for the last couple of days, it has dropped precipitously. So does that indicate that the stress has been mitigated? I guess not for nothing, we did see Bitcoin make a low and a higher low today, and so maybe that is what's going on. However, we did have a big drop in equities today, especially the Nasdaq. And by big, I mean relatively big for day traders. And so you think to yourself, if the funding stresses are gone, why are we still selling off? Maybe there's still other problems within the system that Tom Lee is not really mentioning here or bringing up. But let's just go ahead and continue with what he's saying.
Enough about it, but that funding stress we've seen from the day before, should we be paying closer classes?
as you know, and banks are doing window dressing at the end of month. So I am kind of watching it, but I think those funding stresses have eased, and of course, it hasn't spilled over and reflected in what should be building stress in either credit markets or in bank equities. And so I would just say that it's an anomaly, and it may be due to the shutdown. But yeah, it's worth watching.
Okay. Just the fact that we have had this deleveraging event, if you will, in Bitcoin. I mean, what do you watch to know that that's washed out? And I guess perhaps just as importantly, has this been playing out the way it has previously in the market?
Yeah, in some ways. I mean, I think we have to go back to two different episodes. 2022 when FTX collapsed, and then in 2020 when we had the COVID shock. And in both cases, those were really widespread deleveraging events in crypto, because as you know, in crypto, there is typically a lot of leverage. The October 10th deleveraging was the biggest in history. And that means there are still ripple effects being felt even 2 weeks later. There has been a DeFi protocol streamer that actually reported a pretty sizable loss, and that created further ripple effects. And that's what happened yesterday, along with this thing called the balancer hack. So I'd say it's probably still a couple of more weeks. The good news is there aren't a lot of bodies floating to the surface, so it doesn't feel systematic, but it's going to take some time for confidence to come back. And I think that's why crypto took it so hard in the last couple of weeks.
Got it. So what's the read through to stocks, specifically the QQQ or the NASDAQ 100? We know there's always been this very strong.
I just want to bring up here. So the fact that he's invoking FTX, or what happened the last cycle with Celsius and 3AC, these are all symptoms of what you see in a big deleveraging event, which happens at the beginning or middle of the bear market, which happened last time. So it makes me wonder, like, are we in that now? Because even then, people were saying, "Hey, no, it's not over. We're still going to go up," and then we ended up lower. So we are lower now. Are we going to keep on going down? Are we going to head down to below 92,000, which is the limiter for Bitcoin? If we fall below that and close below that, I would imagine that we're in a bear market. And if that's the case, well, then it's a whole different ball game. But we'll see.
Very strong, or in more recent years, a strong correlation between the two.
Yeah, and the linkages are growing because, as you know, like market makers actually trade both products. And I think in general, people get nervous because part of it is stocks have been up 6 months in a row. And we have to keep in mind that in October, we had the wobble in the first half before markets found their footing. I wouldn't be surprised if people are just pausing here and saying, look, we still have the shutdown. We've had 6 months in a row, stocks are up, markets are overbought, and they get a little nervous. But let's say that just means a wobble in the first half of November. Since 1928, okay, 100 years of data, when markets have been up 6 months in a row, 5 or 6 times you build on those gains with an average gain of 3%. And in 1936, the market was flat. I'm sorry, 1942. So in other words, you either have a flat November or actually strong. It's actually a good sign we've been up for 6 months in a row.
Okay. Given all the focus there's been on stretched valuations, particularly tied to the AI trade, do you anticipate here then into the final weeks of the year that we're going to actually start to see this broaden out a bit?
Yeah, it makes sense. I think, we are doing more Zooms with institutional investors where they're talking about not 2026. So they're trying to position. And I mean, part of me would say, I think the Mag 7 and the AI stocks are still reasonably valued because they're growing at more than double-digit growth rates. And even NVIDIA, the biggest name and most important stocks, only at 29 times forward earnings. So they're not demanding. But there are plenty of stocks that have underperformed for 3 years, where their underperformance is so severe, you haven't seen it in 50 years. And so I think there is going to be some folks looking to buy mean reverting ideas, but I'd still say I like the AI. I think there's a lot of visibility, and I think companies are starting to see payoffs. So it still makes sense to stick with it.
All right, and that's Tom Lee's take. Let's move on down now to this post from H. Horsley on X, who was bringing up this post from Eric Balchunas, talking about the JP Morgan predicting Bitcoin at 170,000 in the next 6 to 12 months. Says perp deleveraging is behind us and that is undervalued versus gold historically, which implies significant upside in the next 6 to 12 months. And Hunter says, everything you need to know about 2025, a TradFi institution raising their BTC price forecast while crypto companies lower their price forecast. Interesting. Speaking of lowering forecast, we have this post from Kathy Wood. She was on CNBC earlier today, and she talks about the idea of what Bitcoin could be worth by 2030. Let's have a listen.
Stable coins are usurping part of the role that we thought Bitcoin would play. So our bullish forecast out there is 1.5 million by 2030. Given what's happening to stable coins, which are serving emerging markets in a way that we thought Bitcoin would, I think we could take maybe $300,000 off of that bullish case just for stable coins. So watch that space. Stable coins are scaling here, I think, much faster than anyone would have expected. Stable coins are
Interesting. So because of the stablecoin usage, Bitcoin forecast is down. Is this portend something to come? Are people going to be making more of these downgrades of forecasts for Bitcoin long term? I don't know. I don't know. I'll know that it's really ramping up when Michael Saylor is the one saying it. Interesting. All right, let's keep on moving here. We have a few more to go through. So this is a post from Lisa Abramovitz, who on X, who was talking about the job situation in the United States. So U.S. companies announced the most job cuts for any October in more than 2 decades. This comes as AI adoption, softened consumer and corporate spending, and rising costs drive belt tightening and hiring freezes. Challenger Gray and Christmas Bloomberg article. So this is see this chart here. We have a massive increase in the number of layoffs in the month of October. It's so interesting. Depending on who you're talking to, they're saying markets are good, economy is good, and other people are saying that it's bad and terrible and getting worse. Really brings us to this K-shaped economy, that there are some people who are doing better, some people are doing worse, certain classes, and depending on what you're paying attention to and depending on what your definition of good is, well, you end up in this situation when you have the exact same situation and two vibrationally different points of view of what's going on. So there's this quick post here from Jack Farley, a clip that he did. Now, this is for an interview that Jack Farley did with Stephen Miran. I'm very much eager to see the full interview for that because I have not seen it yet. And I'm surprised Jack Farley got this interview. So congratulations, Jack Farley. That's pretty fantastic. Let's just take a look at the clip here, which is a few seconds of what Miran has to say about the Fed rate cut decision.
I expect us to cut in December unless there's some sort of surprise. And I guess the reason I would say is as follows. When the chairman speaks, he's representing, to an extent, the range of views around the table. And there absolutely was a wide range of views around the table. But when you look at the distribution of votes around the table, it's different than the distribution of views. And so for that reason, I would expect, based on current information, that we end up cutting in December, but nothing is absolutely guaranteed. At the end of the day, always the scope for new information. But at the moment, my expectation would be that we end up cutting. I think it's the right choice. I think it's the right policy decision. And so I think that we'll end up doing the right thing.
I love how careful he was in what he was saying. I think we're going to cut, but it's not for sure. Don't want to gainsay the leader, Jerome Powell. But then he's also saying it would be the right thing to do. Sort of put in his 2 cents in order to strong arm the decision, give the talking points to people who are quoting him. Interesting. So I'm going to go take a look at the full interview tomorrow because that looks like a lot of fun. Yes, an interview with Stephen Miran from the FOMC does sound like fun to me, and it should sound like fun to you. But don't worry, you don't have to watch it all. If there's anything particularly good, I'll be sure to let you know. All right, our final clip here is from Darius Dale, who is talking about the K-shaped economy. Darius, as I've mentioned before, is top-notch dude. He is, when it comes to research, when it comes to dissecting markets, he's really, really good. Not exactly 100% the best at delivering that information, but I'll take somebody who is highly knowledgeable and very skilled over someone who speaks very well, but gives you very surface level information. So let's take a quick look at his interview on his interview. I won't play the whole thing, but you can go to the Ticket Profit Twitter account, find the video there because it is definitely worth a listen. Let's take a look.
The S&P rebounded today as AMD reported better than expected earnings in its latest quarterly results. Other companies in the AI sector also boosted the markets after valuation concerns just yesterday. Let's go to Darius Dale. He's co-founder, and CEO of 42 Macro. Thanks for joining us today.
Hey, Morella, thanks for having me. I appreciate you.
What factors do you consider when looking at economic growth in the U.S.? Because I know that's one of the things you're taking a look at.
Yeah, that's a great question. So obviously we remain in this government shutdown here. So we have to rely a lot more on leading survey data and data from alternative sources. And by and large, they're confirming the resiliency of the economy, which is a theme we've maintained for over 3 years now. We got the ISM services report this morning, and it was very much in support of an economy that is poised to rebound, particularly when you look at the spread between the backlog and new orders. And so it's our view that we remain on this sort of train track towards a much more expansionary economic environment over the next couple of years.
Can you imagine an expansionary economic environment over the next few years. God, I wish I could speak to him directly, ask a bunch of questions because it's so fascinating that so many people are doomsayers online, making their living about talking about how the sky is falling. It never seems to fall, and then you end up in a situation like this where someone who is particularly knowledgeable is saying that the economy can expand from here. Oof, let's hear some of the reasons of what as to why he thinks that's the case.
You mentioned that you're looking at other sources of information with the government shutdown. Is the government shutdown a drag on the economy?
Oh yeah, of course, of course, it's a drag. I mean, but how big of a drag is it going to cause a recession? And the answer is small and no. And so, in that context, I think we need to move on as investors and focus our attention, our focus budget, if you will, on things that are more impactful for asset markets.
Okay.
In our opinion, we think that. Oh, go ahead.
No, I'm just wondering. You've got a massive government. You've got a massive population. How could a government shutdown that goes so long not really have a massive effect on the way things are run in the country?
Well, if you just think about the categories of spending that are actually impacted by the government shutdown, it's actually not a tremendously large amount. Obviously, if people stop showing up for work at the airports and whatnot, that's where the real shutdown impact is likely to that's what we're likely to see in the economy. But I would turn our attention away from the shutdown because I think it's an overcovered news story to an undercovered news story, which in our view we continue to anticipate. At least our models continue to anticipate structural regime change at the Fed. We think that's the number one story that folks are not paying attention to right now, that markets will be paying attention to in the next 3 to 6 months.
Structural reform at the Fed, big changes on literally how they go about what they're doing, how they're deciding policy and how they're delivering policy. Oof.
Okay, can you explain a little bit more what you're seeing?
Yeah, so our research continues to indicate a Federal Reserve that is K-shaped monetary policy. It's creating all sorts of adverse distributional outcomes, negative outcomes for the consumers and the households on the bottom of the K. And as a function of that, we're seeing an increased amount of pressure from thoughtful investors and economists and obviously the administration circling the institution, and they'll eventually sort of land their punch in terms of trying to get this institution to realize the negative impact that it's having in terms of perpetuating the K-shaped economy. And so ultimately, we're going to see, in our view, until we get something that pushes us off this theme, we think we're going to see a much lower term structure of interest rates next year. And we may even see some creative balance sheet policies to address these K-shaped outcomes that we continue to see in American society.
Has there been any indication of a stimulative effect from the cuts so far?
Not really, but again, monetary policy works with a long lag. When you look at our business cycle model, it's about 18 months where you really see the full impact of monetary policy changes, both up and down in terms of policy rates. But that doesn't mean that markets can't price in what is likely to be a more dovish Fed, a Fed that is more supportive for economic growth, particularly growth for the households and consumers and businesses that have been left behind in this economic expansion, this K-shaped economic expansion.
We talk a lot about valuations and where they sit, especially with the tech stocks. And we saw a big pullback yesterday for the TSX. It was close to 500 points. We've seen the markets come back a little bit back on today. But are you concerned at all about a correction?
Yes. Yes, I'm concerned about a correction. No, I'm not concerned about a bubble. So let me take the first part of the question and answer the second part of the question. On the first part of the question, very much concerned about a correction. If you look at our position model is now signaling high risk of a crash in risk assets over a medium to long-term time horizon. That's just a function of the amount of indicators in that model that are breaching their bull market peak thresholds. And so that tells you that the positioning cycle is very full. And in fact, it's lopsidedly bullish. And so pretty much anything can cause a correction here. A squirrel could get hit by a bus and the market could correct from this starting point. And so, yes, we have to be very much on guard for a continuation of the correction. In our opinion, the number one catalyst for that is this pushback against market pricing for a December rate cut and the Fed's ultimately tardy response to some of the repo market developments that we've been highlighting. With regards to the bubble, in our opinion, the bubble is, to borrow a phrase from our friend Eddie Gabor over at Key Advisors, bubble is not a four-letter word to investors. It's the pop. That's the four-letter word. And so in our view, we think we are a long way away from the bubble popping. We could be wrong on that, but our risk management signals, our institutional grade risk management signals have not signaled that outcome yet.
Okay, so given where we are right now for you, what sectors do you like? Where would you put money in?
Yeah, I think it's going to be a lot more of what's been working. You're going to, so it's technology, consumer staples, or sorry, not technology, technology and communication services in terms of the digital economy growth. We think investors are going to start to broaden out as they get more confirmation over the coming months that the economy is on sounder footing and heading for an acceleration in growth that we believe is likely to surprise consensus estimates to the upside by a material degree over the next couple of years. And so that means you need to attack some of the real economy growth sectors in particular. So that's financials and the home builders as well. And then in terms of where you don't want to be, anything that's slow growth right now, particularly anything that's going to have tariffs moving through its P&L. So consumer staples are obviously an issue there. Healthcare is another issue from our perspective. So
okay, some of the healthcare we know in the U.S. has started to come back, but you're not positive on it.
No, I mean, again, when you're in a risk on market regime, you want to be taking risk. That's kind of the general takeaway. You want to be going further out on the risk spectrum. So high beta cycles from an equity factor and sector perspective. And so that obviously means you need to be underweight consumer staples, healthcare, these sort of more lagging, slower growth, lower beta type sectors and factors in order to outperform. They'll obviously go up if the market goes up, but the reality is, as an institutional investor, your job is to pick factors and outperform. And so that's what we do at a very high level for our clients here at 42 Macro.
Got it. Darius Dale, I'm going to leave it there. I'm out of time. Darius is founder and CEO of 42 Macro. Thanks for your time.
All right. Wasn't planning on playing the full video, but God, I love hearing him lay it out. Just information. Super useful. Definitely go take a look at 42 Macro. I was subscribed to it for quite a while. Not so now because I trade more intraday, but his tidbits are absolutely fantastic. Definitely worth at least a year subscription to go see what that's like. Okay, that's it. We went through it all. We're going to be back next Monday for even more Daily Bread news. Let's hope the sky doesn't fall over the weekend. Oh, actually, no, we won't be back on Monday. I'm going to New York next week, and I'll be in Wall Street, and I'd be happy to meet with anybody who is who's a viewer who's been watching. I'm going to be there under Traders Post. Be given a small little presentation, talk about the state of affairs for retail traders. Over in 2025 and what we're expecting for 2026. It's been very interesting to see the types of things that people are doing. So if you want to come by, it'll be a free meetup. You guys go to meetup.com and look up Traders Post to find it. All right, that's it. That's it, guys. I know you want more, but there's no more today. Let's see what happens with markets tomorrow. Have a great night.